Welcome to the Deep Dive. Ready to maybe unlock some serious tax savings for your family? Today, we're taking a closer look, a real deep dive, into a credit that could put, well, actual money back in your wallet.
Yeah.
The Child and Dependent Care Credit. Our goal here is pretty simple. Cut through the official jargon, give you the insights you need to understand this potential tax break. And we're going straight to the source for this one IRS publication 503, Child and Dependent Care Expenses, the guide for 2024 returns.
And that's exactly right. This deep dive is super important because this credit, it can make a real difference financially. But, and this is the key, only if you get the rules, the definitions. It's all about maximizing that benefit by understanding exactly how it works for you.
Okay, let's unpack this then, because this credit, well, it isn't for absolutely everyone. So step one is figuring out if you even qualify. We're talking about the key tests, the requirements you need to tick off before you even think about filling out Form 2441.
Precisely. Think of them like gatekeepers for the credit. Publication 503 lays out 7 main tests. Miss one, and, well, you can't claim it. Simple as that.
All right, let's start with maybe the most obvious one, the qualifying person test. Who actually needs the care for it to count towards this credit?
Okay, so at its heart, it's your dependent child who was under 13 when the care happened. That's the main group. But it's broader than that. It can also be your spouse or actually another dependent who couldn't physically or mentally care for themselves, and they had to live with you for more than half the year. What's interesting and kind of surprising sometimes is even if someone isn't technically your dependent, maybe because of their income level or they filed their own joint return, they might still qualify. If they meet the other bits, like living with you and being unable to care for themselves, they could still be a qualifying person for this credit.
That's a really key distinction. So when the IRS says physically or mentally not able to care for themselves, what does that actually mean in practice? Is it like needing constant medical help?
It's broader than just needing, say, a nurse. It covers people who can't handle basic daily things, dressing, cleaning, feeding themselves because of a disability. Or maybe someone who needs constant watching to prevent them hurting themselves or others. The pub also gets into the details for kids of divorced or separated parents. Usually it's the custodial parent who gets to claim. And here's a crucial point, just an administrative one, but vital. You have to put the Social Security number, the SSN, or a taxpayer ID number, a TIN, for every single qualifying person right there on Form 2441. Forget that, and the IRS can reduce the credit or just say no altogether.
Right, getting that ID number is non-negotiable. Okay, what about a scenario? Maybe for listeners living abroad, what if their care provider is foreign and doesn't have a U.S. TIN?
Yeah, good question. The IRS actually made that pretty easy. If it's a living abroad foreign care provider, you just write LAFCP on the form. Simple. Otherwise, if someone needs a number but doesn't have an SSN, you might use an ITIN that's for non-resident or resident aliens. Or maybe an ATM for adopted kids waiting on an SSN. You just have to apply for one.
Okay, moving along. Test number 2. The earned income test. So you and your spouse, if you file jointly, you both have to have earned income. What counts as earned income?
Think active work money. So wages, salaries, tips, definitely. Net earnings from self-employment, that counts too. But here's what trips people up, what doesn't count. Amounts you exclude as foreign earned income. Nope. Pensions, Social Security, scholarships not on a W-2. None of that is considered earned income for this test. Keep that in mind when you're calculating.
Got it. Now, there's this provision here that sounds like it could be a real, well, a game changer for certain families. The rule for student spouse or spouse not able to care for self. Tell us that.
Oh, yeah, this is a fantastic rule. It helps households where one spouse isn't bringing in earned income for specific reasons. So if your spouse was a full-time student or they were physically or mentally unable to care for themselves, even for just part of a month, the IRS treats them as having earned income for that month. It's a deemed income. It's $250 for that month if you have one qualifying person needing care, or $500 if you have 2 or more. This basically stops that spouse's situation from disqualifying the whole family from the credit, which is huge. One small catch, though, if both spouses are students or unable to self-care, only one can use this deemed income rule for any given month.
Okay, that's a really helpful provision. Next up, the work-related expense test. Seems obvious maybe, but what exactly makes an expense work-related?
The key here is purpose. The money you spend on care must be what allows you, and your spouse, if you file jointly, to either work or be actively looking for work. It's not just about having an expense while you happen to be working. The reason for the expense has to be work enablement. So, for example, hiring a sitter so you can go out for dinner doesn't count. But say your spouse works nights and needs a sitter during the day so they can sleep. That counts. It enables their work.
Makes sense. What about different kinds of care places? Daycare, preschool, maybe camps? Where does the IRS draw the line?
Okay, so nursery school, preschool, those costs generally qualify. Kindergarten and anything higher. The tuition itself usually doesn't, but, and this is important, costs for before school or after school care for kids in those higher grades can count. Day camps are usually fine too. Overnight camps, though, no, those are generally not considered work-related by the IRS. Also, things like paying a cook or a housekeeper, those can count if part of their job is genuinely for the well-being and protection of your qualifying person. Even agency fees to find a caregiver can be work-related. Oh, and the employment taxes you pay for a household employee who provides the care, like FICA taxes, those count too. There's even a bit of leeway if a tiny part of an expense is for something else, like your housekeeper runs one small errand for you. You usually don't have to split the cost.
Wow, okay, lots of detail there. So who can't you pay? If you want this credit, who are the people you absolutely should avoid paying for care? Seems like an easy mistake to make.
Yeah.
You're right, it is. And the rules are very clear to stop potential abuse. You cannot count payments you make to someone you claim as a dependent on your return. Also, your own child, including a stepchild or foster child if they are under age 19 at the end of the year, definitely not your spouse, and not the parent of your qualifying child if that qualifying child is your child under 13. So no paying the child's other parent if they aren't your spouse.
Good to know those clear lines. Now, for married folks, the joint return test, generally you got to file it together, right?
Yeah, generally that's the rule. Married filing jointly is required to claim this credit, but Publication 503 does provide some really important exceptions. If you're legally separated or if you're married but considered living apart under the tax rules, you might still be able to claim the credit even filing separately. That's a critical detail for people in those specific situations so they don't miss out.
Okay, and the last test on our list, the care provider identification test. Sounds like basic record keeping.
It is, but it's absolutely mandatory. You have to provide the care provider's name, their address, and their taxpayer identification number. That's usually an SSN or an employer identification number, an EIN. If your provider is tax exempt, like maybe a church or a school program, you just write tax exempt instead of a number. Now, what if the provider refuses to give you their TIN? You can't just leave it blank. You need to show you tried. That's called due diligence. Maybe you use Form W-10 to formally request it, or you attach a statement to your return explaining you asked and they refused. It's about showing the IRS you made the effort.
Okay, phew. We made it through the 7 tests. So assuming you, the listener, pass all those, now for the part everyone's interested in, figuring out the amount of the credit, how does that work, and crucially, where are the strategies here? How do you maximize the tax savings from this?
Right. The calculation itself involves a percentage of your expenses. But those expenses, the ones you actually use for the calculation, they hit 2 main ceilings first. There's an earned income limit and there's a dollar limit. After you figure out the allowable expenses under those limits, then you apply a percentage. And that percentage changes based on your adjusted gross income, your AGI.
Okay, let's break that down. First, figuring total work-related expenses. How does timing work? When do you count an expense?
You generally count expenses when you pay them, specifically those paid by December 31st of the tax year you're filing for. But there's a nuance with timing. Let's say you paid in advance, maybe in late 2023, for care your child received in early 2024. You'd count that expense on your 2024 return the year the care was actually provided. And the reverse is true, too. If you incurred expenses in 2024 but maybe didn't pay the bill until January 2025, you'd claim those on your 2025 return. It's about matching the expense to the benefit period.
What if your job helps out, like employer reimbursements? Or what if an expense could also be a medical expense? How does that affect things?
Great questions, because this is where strategic choices come in, affecting your savings. First, if your employer reimburses you for dependent care, maybe through a dependent care benefit plan, you cannot count those reimbursed dollars as work-related expenses for this credit. Same if a state agency gives you a non-taxable payment for care. Second, the overlap with medical expenses. Sometimes, especially for care of a person with disabilities, an expense might technically qualify as both a work-related care expense and a medical expense. The rule is you have to choose. You can use it for the child independent care credit, or you can potentially deduct it as a medical expense if you itemize. But you can't double dip. So you might need to run the numbers quickly to see which way gives you a better tax outcome, the credit or the deduction.
You mentioned employer benefits. That sounds like a really important piece for tax planning. Dependent care benefits. What are these exactly, and how do they really play into the credit?
Okay, so these are benefits your employer might offer. It could be them paying directly for care, or maybe the value of using an on-site daycare center they run. The most common form, though, is probably pre-tax money you set aside in a dependent care flexible spending arrangement, or FSA. You'll usually see the total amount of these benefits listed in box 10 of your W-2 form. Now, here's the tax saving power. Generally, you can exclude these benefits from your taxable income, up to a limit, of course, usually $5,000 per household per year, $2,500 if you're married filing separately. That's a direct reduction in your taxable income, which is great.
Okay, excluding $5,000 pre-tax sounds pretty good. But how does taking that exclusion impact the child and dependent care credit itself? There's a connection, right?
Yes, a direct connection, and this is the core strategic decision for many people. The amount of dependent care benefits you exclude from your income directly reduces the dollar limit for the credit. Remember that $3,000, $6,000 expense limit for the credit? If you exclude, say, $5,000 in benefits, your $6,000 limit effectively becomes $1,000, $6,000, $5,000. Or if you only had one qualifying person, your $3,000 limit would become zero. So the choice is take the guaranteed pre-tax savings from the exclusion or forego some or all of that exclusion to potentially claim a larger post-tax credit. For many people, especially those in higher tax brackets, maximizing the pre-tax FSA exclusion often saves more money overall because it reduces income before taxes are calculated. But for others, particularly those with lower AGIs who qualify for a higher credit percentage, like 35%, the credit might actually be worth more. You really need to look at your specific numbers.
That's a fantastic point about strategy. Okay, let's talk about the other limit, the earned income limit.
Right. This limit basically says your creditable expenses can't be more than your earned income. And if you're married filing jointly, the expenses are capped by the income of the spouse who earned less. So if one spouse earned $50,000 and the other earned $4,000, your expenses for the credit calculation can't exceed $4,000 even if you actually spent more. And remember that special rule for the student spouse or the spouse unable to care for self. Their deemed income, that $250 or $500 per month, counts as their earned income for this limit. That can be absolutely essential. It allows families where one spouse has low or zero actual earnings due to studying or disability to still potentially use a significant amount of expenses towards the credit up to that deemed income level.
Got it. And the other limit, the dollar limit, that's the $3,000, $6,000 one.
Exactly. That's the hard ceiling on the amount of expenses you can use to calculate the credit, after considering any excluded benefits. It's $3,000 total if you paid for care for one qualifying person during the year. It bumps up to $6,000 total if you paid for care for two or more qualifying persons. This is a per year limit, not per person beyond the first two. And here's a useful clarification. Let's say you have two kids, so the $6,000 limit applies. But maybe you spent all $7,000 on care for just one of them. You can still use expenses up to the full $6,000 limit in your calculation. You don't have to allocate it between them. But again, crucially, this $3,000, $6,000 limit gets reduced dollar for dollar by any dependent care benefits you excluded from your income via your employer plan or FSA.
Okay, so we figure our total expenses, apply any benefit reduction, apply the earned income limit, apply the dollar limit. We get a final usable expense amount. How do we get from that number to the actual amount of credit?
Simple multiplication now. You take that final allowable expense figure and multiply it by a specific percentage. And this percentage isn't the same for everyone. It's on a sliding scale based on your adjusted gross income, your AGI. It starts at 35% for taxpayers with an AGI of $15,000 or less. Then the percentage gradually decreases as your AGI goes up. Once your AGI is over $43,000, the percentage drops to its minimum level, which is 20%. This structure is intentional. It's designed to give a bigger boost, a higher percentage of savings, to families with lower and moderate incomes.
That makes sense. So we've navigated the tests, the calculations, the limits. For listeners who made it this far and think they qualify, what's the final step? How to claim the credit?
The mechanics are pretty straightforward at this point. You need to file your main tax return, Form 1040 or the 1040SR for seniors, or 1040NR for non-residents. And critically, you must complete and attach Form 2441, Child and Dependent Care Expenses. That's the form where all these calculations happen. The final credit amount you figure on Form 2441 then flows onto Schedule 3, which accompanies your Form 1040.
Okay, Form 24411 is key. Now, what about the refund situation? Is this credit refundable? Like, can it give you money back even if you don't owe any tax?
Excellent clarification. No, this credit is non-refundable. That's a common point of confusion. What non-refundable means is the credit can reduce the amount of tax you owe, potentially all the way down to zero. But if credit amount is more than your tax liability, you don't get the excess back as a refund. It just wipes out your tax bill, and any leftover credit amount effectively vanishes. It doesn't carry over or come back to you. So if your tax calculated is, say, $800 and this credit comes out to $1,000, your tax becomes zero, but you don't get that extra $200. Still valuable, just doesn't create a refund on its own. And of course, keep good records, receipts for expenses, documentation of benefits, and if disability is involved, proof of the condition and its duration. Always important.
Good advice. Let's switch gears slightly for a common situation. What if your caregiver isn't a daycare center, but someone who comes into your home, like a nanny? This raises the whole issue of household employees.
Yes, and this is a really significant area people need to be aware of because it comes with extra responsibilities. If you pay someone to care for your child or dependent in your home, and crucially, you control not just what work they do, but how they do it, that person is very likely your household employee under tax law. And if they are your employee, you, the homeowner, may become responsible for employment taxes. We're talking Social Security and Medicare taxes, FICA, possibly federal unemployment tax, FUTA, and maybe state employment taxes too. This usually means you'll need to file Schedule H household employment taxes along with your Form 1040.
So, okay, the person you hired directly, like a nanny you found yourself, that's probably a household employee. But sending your kid to the local daycare center, that's different.
Exactly. A daycare center is an independent business. They control their own staff. You're paying the business, not directly employing the teachers. Similarly, if you use an agency that provides a sitter, and the agency controls the sitter's work, sets their pay, etc., then the sitter likely isn't your employee. The agency is. It's a really important distinction because being an employer brings those tax obligations, and you do have to indicate on Form 2441 whether you paid cash wages to a household employee.
Wow, that was incredibly thorough.
Mm.
A real deep dive into the child and dependent care credit. It seems pretty clear that, really understanding these rules, especially the limits and how benefits interact, can lead to some significant tax savings for families.
Absolutely. I think the main takeaway here is, yes, tax rules can look complicated on the surface, but programs like this one are genuinely designed to help families manage care costs. Taking that bit of extra time to understand the definitions in Pub 503, figure out the limits, see how your specific situation fits, it can genuinely impact your bottom line. It's more than just filling out forms. It's about making strategic choices for your finances.
Definitely. And for anyone listening who wants to dig even deeper, don't forget the IRS website, irs.gov. They have Publication 503, Form 2441, all the instructions, tons of resources, and they're free.
And thinking about this, credit raises a broader question, doesn't it? Beyond just getting the credit this year, how can really understanding tax provisions like this help us make, well, better long-term financial plans? Maybe it influences decisions about childcare or even career paths, knowing how these support systems work. It shifts from just tax compliance to more strategic family financial planning.
That's a really powerful thought to end on, how knowledge really is power in managing your finances. Well, you've been listening to The Deep Dive. Until next time, keep digging for those nuggets of knowledge.